One thing that's going to help us with managerial accounting is getting a really good, solid understanding of the accounts that are used in tracking these manufacturing costs and product costs that we've learned a little bit about. So, as you look at these four T's here, they represent T accounts, and in accounting, they help us organize financial information. Now, even though it may not necessarily look like this all the time, on the surface, this is what's happening kind of behind the surface. So what we want to do is first separate the first three accounts. And so what I want to do here, if I can get my screen to work, is, here we go. I'm going to draw a little line here. And this is just to distinguish the difference between some asset accounts on this side and an expense account on this side. So first, we're going to focus on the asset side. So when we track inventory, we are going to use accounts such as raw materials, work in process, also referred to as work in progress, and finished goods. Now you may see these abbreviated as FG for finished goods, WIP for WIP, and RM for raw materials. Now, these are all asset accounts, and they are also known as inventory accounts. The main difference between these three accounts is just understanding that they each are at a different stage in the manufacturing process. So when we look at these accounts, they are all going to have a beginning balance and an ending balance. And that's going to be important to keep in mind for all of these inventory accounts. Just means that we start with something and we end with something. It could be zero, but since they are asset accounts, they're going to continually carry a value. Now, when we think about the flow of these costs, I want you to think about making cookies. So we're going to talk about raw materials. What are the raw materials? Well, the raw materials are direct materials like eggs, flour, sugar. So in this raw materials account, think about all of those being the raw materials used for the finished product. So what's going to increase this account is any purchase of those raw materials. So when we buy eggs, flour, sugar, butter, vanilla, cooking spray, okay, those are the direct materials that are going to be used in production. So what happens is as we use those up, as we use direct materials, those are going to flow into work in process. And what work in process means is that something's been started, but not completed. So now we know how the raw materials account works and the work in process account works. The other things that increase work in process is anytime we add direct labor. So our bakers that are making the cookies, their direct labor gets added. And then the manufacturing overhead. So those are the three components, which if you remember, these are the three types of manufacturing costs. So manufacturing costs increase the work in process inventory asset account. Now, again, remember, these accounts are going to have a beginning balance and an ending balance. So now that we've started our cookies, well, what happens when we finish them and they're ready to be sold? We're going to reduce our work in process account by this thing called cost of goods manufactured. And so as we reduce the work in process account, What that means is we've finished those goods. They're ready to be sold. So that in turn increases our finished goods account. Now, as our finished goods account is increased, again, keep in mind, there's always a beginning balance and an ending balance, even though it can be zero. That's how this account works. And what do we do with finished goods? We sell them. And that represents cost of goods sold expense. So if you think about this, remember, what we've done is we've accumulated all of our costs throughout the manufacturing process, and we have determined now when we sell those products, the cost of those goods to us. As we wrap up this flow of costs, cost of goods sold now increases this expense account. So here's our cost of goods sold. Remember, this is referred to as COGS, increased by whatever costs we're reducing our finished goods by. Now, before we leave this, I just want to point something out. Let's pretend like the cost of goods sold expense, which is made up of direct materials, direct labor, and manufacturing overhead, for selling one cookie at, let's just say Crumble Cookie, is $1, okay? That might be a little expensive, but just for all intensive purposes, that's what we're going to use, okay? Now, knowing that the cost of a cookie to make is $1, what should we sell it for? Well, if you go into Crumble Cookie, the revenue that they are going to earn from a cookie is, let's just say, $4. Okay. Now that we know we have cost of goods sold at $1, the question is, what are we left with? You're right, $3. What do we call that? Well, we're going to start referring to this as gross profit. And that's the value of understanding the product cost or the cost of goods sold of creating a product.